So Jim O'Sullivan is the chief global economist at MF Global, and his estimates on economic data have been accurate enough to make him a Bloomberg best. Jim, welcome back to InBusiness.
Thank you, Margaret.
Yesterday, tough day in the markets. Yes, light volume, but globally we saw $1 trillion wiped out in market value because of these concerns about Italy and contagion. How is that capping a rebound in confidence or rebound in economic growth in this country?
Well, I mean, certainly if the equity market goes down 1 to 2% every day, we're in trouble. But of course, for the year to date, through the ups and downs, the U.S. equity market has held in pretty well. It's up 5 or 6% on the year to date. Arguably, it would have been up more if it wasn't for all these headlines. And I think more generally, these headlines on Europe, on the debt limit issues, and obviously there are questions about U.S. growth, they're all hanging over consumer confidence, and it's so far preventing the recovery from really taking off.
Now, with that question of the debt limit in this country, it seems to be a policy issue at this point. We haven't seen panic yet in the markets with the question of default sort of being shrugged off.
Yes.
And we're not going to get to that point. What is it really that could be a true economic trigger? I mean, you don't expect on August the 3rd, if we get an agreement, to see corporations out there hiring because all of a sudden they know their tax rate. Do you?
I don't think that's going to be a sudden event, but I mean, to the extent we come up with a package on this and the debt limit is behind us, and to the extent there is deficit reduction as part of the agreement, it's not front-loaded, so it's more back-loaded, and maybe there's an extension of the payroll tax cut at the end of this year, then certainly it's if anything, it could be a positive for markets over the next couple of months.
You are a believer in a payroll tax holiday adding to payrolls at most corporations?
Well, it's not so much that it changes the incentive to hire very much, but it's a pure Keynesian boost to spending power. If you've got an extra $100 billion in people's pockets, some of it gets spent. I mean, I think that's the bottom line. And as it's scheduled right now, of course, taxes go up again on January 1st. So it's not a new plus for the economy, but at least it would be the absence of a minus.
Now, today we are reporting Cisco about to lay off 10,000 people. You add that into last Friday's headline with just very weak jobs growth.
Yes.
You think, though, that these aren't telling us the true health of employment?
Well, I mean, certainly every week, of course, we get over 400,000 new jobless claims. So in that broad macro context, 10,000 is not necessarily a huge number, of course, when it's spread out. But I mean, nonetheless, the news has been more negative than positive recently, and claims are up. But that said, you look at the payroll numbers, they're showing 22,000 a month for the last 2 months. The first 4 months of the year were up 179,000 per month. So we've gone from pretty good numbers in the first 4 months of the year to terrible numbers the last two. It may well be the truth is in the middle. You look at how much jobless claims have risen. They don't quite seem to support how much payrolls have fallen off since the first 4 months of the year. So it's not to say that there hasn't been some loss of momentum in the last couple of months, but it is credible that the last two employment reports do overstate that weakness.
So what happens with the next employment report? Do you expect to see somewhat of a swing back?
Well, I mean, certainly I think the trend is better than 20,000 a month. I mean, I think that's the starting point. Now, that doesn't mean we're back to 179, which is where the first 4 months of the year were. I think we'll head there eventually, but for that to happen, we clearly need to start seeing the jobless claims numbers come back down again. And obviously part of that is the backdrop here in terms of does the confidence hit from debt limit negotiations, the Eurozone debt crises, do they fade? Does the drop in gasoline prices start to boost consumer spending a bit more? And there are signs of that. But again, to say that it's better than last month wouldn't necessarily say it's good, of course, but I think it should be better than last month for sure.
And yet, within those numbers, the losses seem to be very much centered on government workers at the state and local levels because of austerity there. You also saw temporary hiring was pretty weak. So we're not just talking about things like payroll tax holiday boosting employment. I mean, these are issues that are going to be ongoing.
Yes. No, absolutely. State and local government employees are dropping. And I mentioned the plus 179,000 in the first 4 months of the year. And that was with over 20,000 a month of negative from government workers. And that's not suddenly changing. It doesn't look like that's getting any weaker. Even on Friday, the government part for state and local was minus 25,000, which wasn't all that different from the recent trend. Now, there was a big drop in federal of 14 as well, which is a little at odds with the trend. But ultimately, the trend's going to be set by the private sector. And again, that has slowed in the last couple of months, absolutely.
All right. Jim, thank you very much for bucking the trend and telling us it's not as bad as the numbers are indicating at this point. Jim O'Sullivan, chief economist at MF Global.